Hi, and welcome to this new video. Last 2, 3 days, markets have been extremely volatile. They've been all over the place, especially the small caps and mid caps have seen a fairly large cut. And during these times, I keep getting messages and emails from friends and investors on how one should approach investing in such a market. So I thought, let me, pen down my thoughts and speak about it so that one, it helps others, and second is it also sort of reinforces my own learning. So, uh, what we've seen over the last today is the third day, Friday, Monday, and today. Markets have been very volatile, large. Small caps and mid caps have seen very large, down moves, especially the PSU, defense, railway, etc. Those the stocks which had gone up a lot have seen very large corrections in the last in this period, and it keeps people start wondering what to do. So uh, see, basically, if you see what is it that a stock can do or a market can do, essentially there are only three things that happen: either the stock goes up, or it goes sideways and consolidates, or it goes down, right? And you will notice that over a period, markets don't go up or down linearly. What that means is every day the markets will not go up or neither will it go down. It typically happens that markets will go up, say, for 4 or 5 days, then it'll take a breather, or it'll go down for a couple of days, then it'll maybe go sideways for 2 more days, and then it'll go up again. And that is how the market sort of behaves in normal circumstances. So this is very important to keep in mind when markets are falling, that markets don't keep falling every day. uh, Typically you will see a 3 4 day fall, then a pause, then maybe a move up, then uh, depending on the overall trend of the market, you will see how the market actually behaves. Now, the other important thing to remember is that when we are in a bull market, and typically the way I define a bull market is when markets are trending upwards, right? Stocks are going up and indices are going up, which is the situation more or less today. I mean, we are in an up move. So, in a bull market, it is very, very normal to see very short and sharp corrections, right? We can see very sharp falls in the market for 2 3 days, 4 days in an ongoing bull market. So you have to take that as par for the course. Now, when such sharp moves happen, especially on the downside, what are the things that we can do? Again, there are essentially three choices that we have as an investor, and the first choice is my default choice, which is to do nothing. Now, if I've invested in a stock where I have reasonable amount of conviction, then I don't need to react to every price movement. Right? The problem today is twofold. One, people invest without any conviction. They have no clue about the stocks that they have invested in. They've heard of it, you know, from somebody else. A friend would have given them a tip, or they would have heard it on TV or somebody on Twitter or YouTube, etc. Uh, and they would have gone ahead and bought that stock. So in those kinds of circumstances, very easy to panic when the price falls, because you are clueless. You don't know why you've bought the stock in the first place. The other problem is that nowadays what I see, especially with mobile apps, broker apps, or the other very common one I see is the money control portfolio app, and everybody is glued onto those. They're constantly checking the portfolio value, whether what has gone up, what has gone down, and the moment you do that on a hourly basis or on every few minutes, uh, it prompts you to react, right? If you continuously bombard your mind with price fluctuations, and especially on days when price fluctuates a lot, it's, your mind is going to be tempted always to do something, right? uh, that's a very difficult position to be in. So my default action that I do is I do nothing. uh, the second option which is there, which is, uh, if you have predetermined stop losses in place and they are getting triggered, you need to sell, right? So few key points here: one, it has to be predetermined. You should not be selling in panic. Second is that, even if your stop losses are getting triggered, you can always, sort of, when in doubt, I mean, this is the maxim that I follow personally: when in doubt, sell half. So whenever you are feeling that, okay, things are not going your way, and maybe this was a trading position, or maybe you did not know a lot, or you were just beginning to build up the position, and prices have come down, you want to get out of the position, you can always take out one fifth, I mean, 20% or 25% or 50% of the position, and then wait for a couple of more days and see how things are going, and then, if and then take a call, basically. So that's the second thing I do. Another point to remember when you're thinking about stop losses is, stop losses need to be determined differently for your trading bets versus your investment bets. So when I am doing my quant or my techno funda, I will have much shorter stop losses versus my investment bets, where I have much more fundamental, depth of conviction. So I will have much more larger stop losses in those. The whole idea is, in your long term positions, you don't want to get whipsawed out of a position that you have, which you believe can give you decent returns over the next 2 years, 3 years, 5 years, right? The third option that you can have, or that you can do, is you can buy more when the prices are going down. Now, typically, that is the last option for me, and I essentially follow uh, the rule that I typically only average up. What that means is, if I have bought a position at 100, it has gone up to say 120, then it has fallen back to say 110, I am probably going to be in a I would be more than willing to buy this, because it's 110 is higher than the average price that I have paid to buy my initial position. So I am averaging up all the time. uh, I rarely average down. Averaging down basically means that if you bought your position at 100, your average buying price is at 100, and the stock is now at 890, uh, you buy more. Now, the problem with averaging down is that you are always, your buying price is always going to be more than your market price. So, in this example, let's say the market, you've bought initially at 100, uh, current price is 90, and you buy, say, additionally at 90, then if you bought the same quantity, both the times your average price will be 95 and the current market price will be 90, right? So you're always in a losing position, whereas when you are averaging up, you are always in a winning position. So if you've bought initially at 100, you're buying more at 110, your average price is 105 and your market price is 110. So you're still profitable. So that's the way I want to build up my positions. The only caveat, or the only exception to that, is when I am initiating a position. So let's say when I'm starting to build up a position, I want to, let's say, build up 5% or 10% of my portfolio. Then I will not be doing it on one day. I will be staggering my buys over a period of time. And what we do is that, what we will, I'll keep buying, say, 1% of my portfolio on every day or every subsequent days, something like that. Or I'll do it mechanically. I'll buy it once every once a day for every day of the week or something like that. I'll figure out a consistent method of buying. Uh, so these are essentially the only three things that you can do, in my opinion, or what I do in my order of preference is, obviously I do nothing. Then I'll, if stop losses are getting triggered, I'll get out, uh, maybe partially or maybe fully. And third is I will average up if that is possible, or if I want to do it. But I will average up again. Another point I want to mention here is I will not try to catch a falling knife. If the market is falling, if a stock is falling, I'll let it fall. I'll let it find its place where it can sort of uh, hold its price, and then I'm happier buying on the way up. I know I will not get the lowest price, but I'm okay with that because I am not looking for the lowest price. Uh, I want to minimize my risk, right? Because when a price is falling, let's say from 100 to 90, I don't know whether it will go to 80 or 70 or 60 or 50. Whereas if it has fallen from 100 to 80 and then bounced up to 85, I know that okay, it's probably on the in the short period, it's on the way up. Okay, so that's the way I would do it. Now, the next question that is very common is, I have cash in the market and the market is falling and I wish to enter. So what and how do we go about that? So first is I what I do typically is I look at my portfolio, I look at my watch list and see if there is any stock in there where in my portfolio where the allocation is less than what I want it to be. If that is the case, I will add to that. Or if I have a stock in my watch list, uh, and it sort of uh, is not falling as much as uh, or it is fallen and it's found a bottom, then I will probably start deploying capital to it. I typically, when I'm buying, especially in a very volatile market, I will deploy my capital in 4 5 chunks, maybe sometimes even more if the market is very volatile. So let's say I have 100 rupees to deploy in this month. What I will think is, okay, I roughly have 20 to 22 days of trading days, and if the market is very volatile, 1 in 3 days is going to be a down day, right? So roughly, I will get say 8 days or 7 days where markets will go down. So I will divide it into 7 chunks, and 100 rupees I will sort of break it up into 7 parts and uh, deploy 1/7 of 100 every day the market is down. That is the way I would sort of go about it. And uh, if if there's no one stock that I would want to get into, I will probably get into my entire portfolio. So proportionately, I will buy. The other question that is also very common is if some stocks are falling more than others, uh, should I buy more of those? So some stock has fallen 5%, other has fallen 10%. So should I buy more of uh, the one which has fallen 10%? Now that is going to be a function of the conviction that you have, right? And it is going to be a function of the allocation that you've thought about. Now, when a stock falls, say 10%, and another stock falls 5%, and if you had both at the same allocation initially before the market fell, the allocation for the first one, which has fallen more, is going to get lesser, right? So, if you have equal conviction, you may want to top that up more than the other, right? So, it's all a function of your conviction and allocation. Okay. Uh, the other important thing to understand is when in the current environment of the market, what we are seeing is that we are seeing pretty regular sector rotation. So stocks which have gone up a lot are the ones where we see more correction. So in this last 2 3 days, you would have seen PSU stocks, railways, defense, etc., fall more than these some of the other areas where the rise also had not been so meteoric. So stuff which has gone up very fast, people tend to want to sell and book profits in those. So they tend to fall more also. Uh, I've always, like I said before, I've believed in being more prudent, letting the market stabilize before jumping in. I don't want to, when the market is crashing, to be jumping in, because my capital is limited. I don't have unlimited capital. So I want to protect my capital, and I want to ensure that the market is stabilized, it's not falling a lot, and it's either finding a bottom or it has already formed a bottom, and that is when I would want to buy. It basically just improves the odds in my favor. The other question that is very frequent is, if some stocks fall more, based on the results, should I buy more of those? So let's say a company that is in my portfolio is not done so well in the quarterly results, and now being the result season, the stock has maybe reacted very negatively. So do we, buy more? So the answer to this is very simple. These are two completely separate decisions, right? So whether you want to buy, hold, or sell is a completely different and a distinct decision from whether you want to add, when the market is falling. So if your fundamental call is to be selling a stock, right, you would want to, because the results are bad or whatever, you would want to be selling anyway, whether the market is going up or down, right? So if you believe that the position that you're holding is has lost the thesis that you bought it in for, then you have to sell anyway. It has nothing to do with what the market is doing. uh, so uh, you you should react more based on the fundamental results, if that is what is driving your decision. And always remember that you don't have to react to everything, right? If you have a 3 year or a 5 year horizon for a stock and the story playing out, you don't want to sort of get out just because one quarter has been good or bad, right? And like always, what I keep saying is, this kind of a volatile market is extremely good for doing SIPs. So whether it's in your stock portfolio, whether it's in a small case, whether it's in a mutual fund, whether it's in your PMS, whichever way it is, uh, the SIP, or a systematic investment program, is what you should be having, whether you're putting money in on a weekly basis or a monthly basis, whatever. A steady inflow of capital into your portfolio is what is much better, because it positions you psychologically in a better place than putting in all your money as a lump sum, and then the next day maybe the market falls 5-7%, or uh, and you can sort of avoid that if you stagger your money and put it in. So in summary, markets are volatile. Essentially, these are the points to remember. One is, your default position should be to do nothing. Sell if your stop losses are triggered. Sometimes partial selling is a good option. When in doubt, sell half. That's the maxim. If you have cash, spread out your buying. Let the market and stock settle down to an extent before you start buying. And if all of this sounds very complicated, just stick to a monthly SIP mode of investing, and keep a long-term orientation, and have faith in the Indian stocks, Indian businesses, and the Indian markets, and you'll come out fine. With that, let me close for today. Thanks for spending time on listening to this. And if you have any questions or comments, feel free to put it in the comment section, or writing back to me. Thank you.